There is a piece of math that almost nobody in personal finance talks about openly. It changes the entire Roth versus traditional IRA debate the moment you actually see it. If your tax rate is exactly the same today as it will be when you retire, a Roth IRA and a traditional IRA produce exactly the same after-tax wealth. Not approximately the same, but exactly the same. And the math is completely airtight, no matter how you run it. Which means the entire debate collapses into a single question that almost nobody is answering carefully. Are you going to be in a higher tax bracket in retirement or a lower one? That is the whole game, and most people are either guessing or defaulting to whatever they heard first. This video is about the real math behind the Roth IRA versus traditional IRA decision, and what it actually depends on. Here is how the two accounts work at a basic level, because getting them clear matters before the interesting part begins. A traditional IRA lets you contribute money before it has been taxed, and that contribution reduces your taxable income this year. The money then grows tax-deferred inside the account, and when you take it out in retirement, you pay ordinary income tax. The government waits patiently, but it eventually collects every dollar it is owed on those withdrawals. A Roth IRA works in reverse because you contribute money that has already been taxed, and there is no deduction today. The money grows completely tax-free, and when you take qualified withdrawals in retirement, you owe nothing on any of it. For 2026, the IRS sets the contribution limit at $7,500 per year if you are under 50. If you are 50 or older, you can contribute up to $8,600 per year across all your IRAs combined. The Roth has an income ceiling, and if you earn above a certain threshold as a single filer, your ability to contribute phases out. The traditional IRA has no income ceiling for contributions, though deductibility phases out at higher incomes if a workplace plan is involved. On the surface, the Roth sounds obviously better to a lot of people, with tax-free growth and tax-free withdrawals in retirement. But the math, when you actually run it, tells a more complicated and honestly more interesting story than most people expect. Here is why the traditional IRA deserves more credit than it usually gets from the people who call Roth the automatic winner. When you contribute to a traditional IRA and receive a tax deduction, you are effectively getting a refund on taxes you would have paid. If you are in the 22% federal bracket and contribute $7,500, you save $1,650 in federal taxes. That money does not disappear, and if you are disciplined, you invest it so it compounds alongside everything else you have saved. The Roth, by contrast, uses after-tax dollars, meaning every dollar that goes in has already been taxed before a single dollar of growth happens. The Roth bet is that paying now is cheaper than paying later. And that bet is correct under specific conditions, but not all of them. Now consider a simple illustrative scenario with clearly stated assumptions so the math stays honest and transparent throughout. Assume someone contributes $7,500 per year to either a Roth or a traditional IRA with a 7% average annual return. Assume they are in the 22% federal tax bracket today and will remain in the 22% bracket in retirement. Assume they also invest the tax savings from the traditional IRA rather than spending them on something else entirely. After 30 years of contributions under these assumptions, both accounts deliver the same after-tax wealth. And not just close, but identical. The traditional account has a larger nominal balance because the pre-tax dollars compounded at full size over all those years. But when you apply the 22% tax on withdrawal, you arrive at exactly the figure the Roth produced with no tax due. That is the mathematical identity at the center of this entire debate, and it only breaks when the tax rates diverge from each other. So the question is never really Roth versus traditional, because the real question is always a prediction about your future tax rate. If you believe you will be in a lower bracket in retirement, the traditional deduction now is worth more than the Roth benefit later.
If you believe you will be in a higher bracket in retirement, the Roth wins by exactly the amount your bracket increases over time. Here is where things get more interesting, because 5 real variables break that tie in practice, and most people underestimate at least 3 of them. The first variable is required minimum distributions, which force traditional IRA holders to start taking withdrawals by age 73, no matter what. These mandatory withdrawals are taxed as ordinary income, and they do not care what other income you already have coming in that same year. If you also have Social Security income, a pension, or rental income, those required distributions can stack and push you into a higher bracket. Roth IRAs have no required minimum distributions during the original owner's lifetime, so the money can sit and grow for as long as you live. That difference in flexibility is genuinely valuable, particularly for people who expect more income in early retirement than they initially planned for. The second variable is what you actually do with the traditional IRA's tax savings, and this one trips people up more than any other. The mathematical tie we established earlier assumed that the tax refund from the traditional deduction gets reinvested somewhere productive and left to grow. If you take that $1,600 tax saving and invest it back into a taxable brokerage account, the traditional account can hold its own. But if you spend it, the comparison shifts, because the Roth had you paying tax up front and investing the full compounded amount from the start. This is a behavioral variable as much as a mathematical one, and it matters significantly over a long time horizon like 30 or 35 years. The third variable is Social Security, and this one is underappreciated by most people who are modeling their retirement income picture. Up to 85% of your Social Security benefits can become taxable, depending on your combined income, which the IRS calls provisional income. Withdrawals from a traditional IRA count toward that provisional income figure, but withdrawals from a Roth IRA do not count toward it at all. A retiree drawing primarily from a traditional IRA may inadvertently trigger taxation on Social Security that a Roth-heavy retiree avoids entirely. The effect compounds over years of retirement and can represent a meaningful real-world difference in net income that a simple bracket comparison misses. The fourth variable is flexibility before retirement, because Roth IRA contributions, not earnings, but original contributions, can be withdrawn anytime without taxes or penalties. You already paid tax on that money, so it is yours to access whenever you need it, without any additional cost or restriction. The traditional IRA offers no such flexibility, and early withdrawals before age 59.5 generally trigger income tax plus a 10% penalty. For someone in their 30s or 40s who values optionality, the difference in accessibility is real and worth factoring into your decision. The fifth variable is what happens to the account after you die, which is a planning consideration that belongs in the honest accounting here. Under current law, a Roth IRA owner facing no required minimum distributions can allow the account to grow completely untouched for their entire lifetime. Non-spouse beneficiaries generally face a 10-year distribution window under current legislation, regardless of whether the account is a Roth or traditional. But the Roth's tax-free nature can still be meaningfully advantageous for heirs receiving distributions, particularly if they are in higher income brackets themselves. Now, carry some of these variables forward over time to see what they actually produce, keeping all assumptions clearly visible throughout. Assume a 30-year-old contributing $7,500 per year at a 7% average annual return, which is illustrative and not a prediction. Assume a 22% federal tax bracket today, and now consider 2 separate paths to see where they land after 35 years. In the first path, this person contributes to a traditional IRA for 35 years and invests the resulting tax savings separately each year. By age 65, the traditional IRA has a larger nominal balance than the equivalent Roth because every contributed dollar was pre-tax and compounded at full size. But at withdrawal, Those dollars face ordinary income tax at whatever rate applies in retirement based on total income from all sources. If retirement income keeps them in the 22% bracket, the outcome is essentially even with the Roth, just as the math predicted. If income stacks in a way that pushes distributions into the 24 or 32% brackets, the Roth wins by the full rate difference. In the second path, this same person contributes to a Roth for 35 years, using after-tax dollars that have already been taxed up front. The account's nominal balance is smaller than the traditional equivalent, but at withdrawal, every single dollar is free of federal income tax. No tax on the growth, no tax on the principal, and no required distributions forcing income into any bracket at any point in retirement. By year 20, the behavioral advantage of the Roth becomes clearer for most typical savers who are living real lives with real spending pressure. The discipline of investing the traditional's tax savings consistently over 2 decades is harder to maintain than it sounds when life is actually happening. The Roth structure removes that decision by forcing the tax payment up front and then letting every dollar of growth accumulate completely untouched. The picture changes meaningfully for someone in their peak earning years who is sitting in the 32 or 35% federal bracket today. A 45-year-old in that range who genuinely expects to retire on significantly less income has a compelling case for the traditional deduction right now. Paying 32% today to save 22% later is a bad trade, and the math on that is straightforward and unambiguous. Paying 32% today to potentially pay 12 or 22% in retirement is a genuinely good trade worth taking seriously. The math is the same in both cases, but the inputs just favor a different account depending on your actual situation and trajectory. The honest case for the traditional IRA is strong, and it deserves a genuine defense rather than being dismissed as the less exciting option. The fundamental economic argument is this: a dollar that is not taxed today is a larger base for compounding over the years ahead. When you contribute to a traditional IRA and defer the tax, you are effectively investing the government share of your money alongside your own. You are not avoiding tax, you are borrowing the government's portion of your contribution and putting it to work before you ever have to repay it. If your investments perform well over a long horizon, you benefited from compounding on a larger principal for a longer period of time. The Roth forces you to pay that share up front, which means your compounding base is permanently smaller from the very first day you contribute. This matters most when someone's current marginal tax rate is genuinely high and their expected retirement income is genuinely and substantially lower. A person earning $200,000 today and planning to retire on $70,000 per year is looking at a real bracket differential. The traditional deduction at 32 or 35%, paid back at 22% or lower, represents real money saved over decades of withdrawals. There is also a strong argument around tax diversification that sophisticated retirement planners use to manage income in retirement with real precision. Having both pre-tax and after-tax retirement assets gives you the ability to control your taxable income in retirement on a year-by-year basis. You can draw from the Roth in years when traditional withdrawals would push you into a higher bracket or trigger more Social Security taxation. You can draw from the traditional in years when you have unusually low income and want to fill up a lower bracket efficiently and deliberately. That optionality has real value, and the people who plan for it tend to keep meaningfully more of what they spent decades building and saving. Here is the durable insight from all of this, and it reframes the entire conversation in a way that makes it actually useful going forward. The Roth versus traditional debate is not actually a debate about accounts. It is a debate about tax rates across time and nothing else. Most people are making a tax rate prediction without realizing that is what they are doing when they choose one account over the other. The account you chose, or the one someone recommended,
embedded a quiet assumption about whether your future tax rate will be higher or lower. That assumption is doing a lot of work in the background, and it is genuinely worth surfacing and examining before your next contribution. The federal tax brackets for 2026 run from 10% at the bottom to 37% at the top across 7 distinct tiers. The Tax Cuts and Jobs Act rates were made permanent by legislation passed in 2025, which gives more predictability than existed just a few years ago. But state taxes vary, retirement income sources stack in ways that are not always obvious, and required minimum distributions can arrive with Social Security at the same time. The Roth's flexibility has genuine value that does not show up cleanly in a 30-year spreadsheet, no matter how carefully you build it. None of this means there is one right answer, because the quality of your answer depends entirely on your own retirement income picture. Not your retirement savings picture, but your income picture. And those two things are meaningfully different and worth thinking about separately. So before your next IRA contribution, here is the one question worth sitting with honestly before you decide which direction to go. Based on your career trajectory, your other retirement accounts, your likely Social Security benefit, and your spending expectations, do you expect a lower, higher, or similar bracket in retirement? If you have a real answer to that question, you probably already know which account serves you better in your specific situation. If you do not have a real answer yet, that is actually the most useful thing this video gave you, because now you know the right question to find. If you want to go further, the natural next conversation is Roth conversions, which let you move money from a traditional IRA into a Roth on your own terms. That strategy has its own math worth walking through carefully, and it is where a lot of the real long-term planning advantage actually lives. If this gave you something genuinely useful, the subscribe button is there. And if you want more of this kind of thinking, it is worth clicking